China is playing a dangerous game with its currency, moves that could send the global economy into recession. So what could this mean for gold? Joining us now is Martin Mureenbeld, chief economist for Dundee Economics, to share his outlook on the yellow metal. Martin, thank you so much for joining us today from California.
You're more than welcome, Dania.
Well, let's look at gold, which hit a two-month high today, back above 1,100. How much of gold's rally today is really due to the yuan being in crisis right now?
Well, it is to some degree, but I think the big issue here is the equity markets. Obviously, the Chinese equity market is tumbled, and they've got breakers on, so it tumbled 7%, and that was it. And that has affected global equity markets, and of course, North American equity markets. Now, to understand that relationship with gold, we got to go back to around 2012, 2013. When we saw the big move down in gold prices. And that big move down in gold prices was predicated on a massive shift out of gold and into equity markets. As investors told me at that time, they liked the gold story, but they weren't making a lot of money on the gold side, and certainly not the hedge funds. And the hedge funds moved heavily into equity markets instead, and they've done very well. And so what we've seen over the last 3 or 4 years is a strong negative correlation between equity markets and gold. So to put it differently, the gold investor has moved out of gold and into the equity markets. And what we're getting now is some uncertainty about the equity markets, obviously lots of volatility. And the outlook for the equity markets for this year has tended to come down for those that follow equity markets closely. And I think that has made gold more interesting again. If it's a play against the equity markets, and that's what you'd expect on a negative correlation, then it's really the equity markets that are helping to buoy gold here.
So what forecast are you looking at for gold right now?
Well, we had a forecast, our last forecast was in October, and we had a sort of an average for next year of about 1175. Now we're right in the process of updating that. We update that quarterly, and it'll come out tomorrow, as it turns out. But I'm comfortable with an 1175, given the kind of problems we see developing this year. I don't think it's going to be a great year for equity markets. It may not be a bad year, but I don't think it's going to be as good a year as it has been in the past. And that's certainly what we're seeing here. And China does have the potential of undermining growth in the world economy somewhat. Not necessarily the US, but worldwide, yes.
Well, what do you make of the comments that billionaire George Soros said today, that it reminds him of 2008, and he warns of a financial market crisis and that China's currency devaluation will impact the rest of the world? Do you agree?
Well, it definitely impacts the rest of the world. The Chinese currency is fundamentally seriously undervalued. China runs a trade surplus of about 370 billion with the US. The last thing the U.S. really needs is for the yuan to come down further and make Chinese goods even more competitive in the U.S. market. So, the overvaluation of the dollar has hurt the U.S. economy, and the worse the overvaluation of the dollar gets, the more it puts brakes on the U.S. economy. Do I see a 2008? Probably not. I don't expect that any significant financial institution on this side is going to break down. There's clearly some potential for financial institutions to go under in China, but I think that will be contained over there. I think the other point within what George Soros may be saying is that, and we're very much of that view, that the Fed will actually not be raising rates as much as the market expects.
Okay.
The market's consensus is, maybe four hikes this year.
So you think there'll be no more hikes?
Well, our last forecast put in 1, so we're already under the consensus, and the forecast prior to that had no hikes in 2016. So we're kind of sitting there with this idea that the Fed really is not in a position, given the equity market volatility, given the strong dollar, and given how China may unfold this year.
Right.
I don't think the Fed is in a position to really seriously raise rates.
Do you think that they jumped the gun, that they raised rates too soon?
Well, from an economic point of view, there was really no requirement for it to raise interest rates, but there's a certain dynamic at the Fed, and they desperately wanted to get off the zero lower bound, and they were prepared to do this in September or thereabouts, but then we had that problem in August, as you recall, with the renminbi and equity markets being shaky and so forth, and so they decided to go. So whether they should or shouldn't is now water under the bridge. The question really comes down to, will they hike significantly in 2016? And our view is it will not. And this will actually help to buoy gold a little bit in 2016, the fact that the Fed will back off a bit.
And with the time we have left, Martin, just want to get your thoughts on another currency which is sliding, the Canadian dollar. The Canadian loonie has now reached its lowest level since 2003. What's your sentiment on Canada? I know you're Canadian-based. Will it get better?
Well, I don't see it getting better for the time being. Our last forecast on the Canadian dollar had it, somewhere in the 68-cent range. So that's still another couple of pennies below where we are now. We're close to 70 cents. The Canadian economy will be sluggish this year. I know the Bank of Canada has a number of 2% for the coming year. Our number is a round number of 1% for 2016. It's going to be difficult in Canada for the next year. So we're not looking for the Canadian dollar to improve. What we really need to see is a pickup in oil prices for the Canadian dollar to improve. And, you can roll the die on that one.
Thank you, Martin. And finally, if someone wants to get a hold of your report, where can they go?
They can go to www.dundeeeconomics.com and sign up there and receive our reports on a trial basis.
Thank you so much for your time today.
Thank you.
And thanks for watching this edition of The Gold Report. We'll see you tomorrow.